What is going on? This is the question that I've been getting from so many of my clients over the last couple of weeks. And it's come in different forms. Hey, what happened at Silicon Valley Bank? What does this mean for my cash? Is it safe? Should I move it from one bank to another? Is this 2008 and 2009 all over again? And if that's the case, should I be pulling my money out of the stock market or should I be investing more? I probably fielded 15 separate client inquiries over about a 5-day period right after this happened. And I've had a few more trickle in since then asking, hey, what should I do about this and how should I think about it? And the purpose of this video is to share a few lessons from the Silicon Valley Bank failure and to share what it means for your money. If we haven't met, this video got shared with you. My name's Jeff Clark, and I'm a financial advisor. And at Redwood Money, I help about 70 families manage their money. And one of the things I do is keep a close eye on markets, what's going on, so that my clients, candidly, don't have to. And so for my clients, the primary purpose of this video is to provide you with reassurance that your cash is safe and that we don't need to make major changes in your financial plan based on what happened. But the secondary purpose is to take some lessons from what happened at Silicon Valley Bank and to use those to inform how we think about our own investments as we look to the future. Because there are always lessons when something as big as the second biggest bank failure in the US happens. There's lessons that we can all learn and apply. So hopefully I've condensed a couple of weeks of news into a helpful video that you can watch and you can share with your friends. So in this video, we're going to start with a couple of reasons to relax. You may watch those and say, great, that's enough for me to know, Jeff. I'm tuning it out, and that's fine. But if you want to go a little deeper, we're going to talk about what happened specifically at Silicon Valley Bank as more and more information has come out on what kind of happened between 2020 and 2023 that led to this run on the bank that happened pretty spectacularly about 2 weeks ago. And then we're going to pan out even further and talk about market turmoil or volatility and our financial plans, because there are constantly things in the news media cycle that could cause us to maybe deviate from the solid financial plan that we have in place. And sometimes those deviations can be beneficial, but more often they're detrimental. So we want to talk about how we think about volatility, how it can actually accrue to our benefit, and we can be strategic in the midst of these times of volatility. And I'll close with a couple of next steps. So let's start with a couple of reasons to relax. The first big question people are asking me when this happened is my cash safe? And in short, the answer is yes. At least your deposits are safe. Is your cash losing value to inflation right now? Absolutely it is. But when you look at your balance, that money is safe if it is at an FDIC insured bank. And here's some good news. No Redwood Money clients banked at Silicon Valley Bank. In fact, it's kind of a niche bank that focused primarily on early stage startups and on the venture capitalists who funded those early stage startups. So first of all, no real risk there. But even more broadly, if you bank at any FDIC insured bank, you're going to have $250,000 of FDIC insurance. So if your balance in your bank account is lower than that in a personal checking or savings account, that money is insured. And if you have a joint account, then each depositor, you and your spouse, gets $250,000 of coverage. So you get $500,000 of combined coverage. So what happened at Silicon Valley Bank is when it was announced that they were going under on a Friday, the people who had that much or less in their bank accounts were told, hey, on Monday, you're going to have access to your money. The people who were concerned and the companies that were concerned were the ones who had $25 million or $50 million in it because they were a company that had put all of their monies with this bank and they needed to make payroll the next week and they weren't sure when they were going to have access to their money. A little bit more on that later. So now specifically for clients, for many of my clients, if you have a bunch of money in a bank account, it's for a very specific reason. We have a goal that we're funding, or you need a larger reserve for your business. This is one of the reasons that I love having high yield savings accounts opened at Betterment, is that you have $1 million of FDIC insurance on an individual or a trust account and $2 million of joint FDIC insurance on a joint account. How do they do that? Well, Betterment partners with multiple banks. Right now there's 8 on their roster that they will put deposits into when you deposit your money there. None of them are Silicon Valley Bank or Signature Bank, which also went under. But they have them at those banks, and that actually causes you to benefit from additional FDIC insurance. So short answer, is your cash safe? The answer is yes. That's how FDIC insurance works. And it's something that I monitor with clients for making sure that your money is insured. Now, secondly, what about the broader banking system fallout? And what does that mean, not just for my cash, but for my entire financial plan? Well, a few things that you should find reassuring. This was a very concerning event because what happened at Silicon Valley Bank is there was really a run on deposits. Within about a 24-hour time span, as people realized that the financials at Silicon Valley Bank weren't great, they withdrew about $43 billion in deposits. That's a scary thing, not just for that bank, but for every regional bank that could be concerned that in today's digital age, somebody can pull out their phone and they can say, I'm pulling all of my money out of this bank account, and they can tweet about it, and those things can reach a critical mass of withdrawals. So what happened over the weekend? There was, on a Friday, California took over the bank. They put it into what's called receivership. Well, by Sunday night, before the stock market opened on Monday, there was so much attention paid to this issue that there was a decision by the Federal Reserve and by the Secretary of the Treasury, Janet Yellen, and President Biden was involved, and they announced a few things that they did to shore up Silicon Valley Bank. They said that uninsured depositors, people with more than $250,000 or $500,000, would have access to all of their money that week. They also said that they were setting up a fund for other regional banks that might face a similar issue where they could borrow against it if they needed some money to shore up in the face of deposits. And also that later we're going to talk a little bit about some bond stuff, and what got Silicon Valley Bank in trouble was they had these bonds that had reduced in value. And so when they had to pay back depositors, they weren't able to do it because the bonds had reduced in value. And there was a system basically set up by the federal government to help people to be able to sell those bonds at their full value, borrow a little bit of money from the government so that these runs on the banks would be diminished. The whole purpose of this was basically to tell everybody in the US that the answer to that question, is my cash safe, can be yes, so that there wasn't any more turmoil. So they're trying to reduce the fallout. Now, there have also been other interventions at other banks. First Republic is another large bank. They're a top 20 bank in the US based in San Francisco. And even though they've had a lot of trouble, they had like $30 billion of a cash infusion from many banks. You had Credit Suisse get taken over by UBS. And this credit facility that I just mentioned, they all got set up. And so what you need to understand about the stock market and about your money is that it is a complex, adaptive system. So complex means there's many actors in the market. So when news like this happens, it doesn't happen in a vacuum. Immediately, there's a bunch of action from market participants. Things like people pulling money out of banks, which is scary, but also things like regulators stepping in to provide support. And those can form an equilibrium. And so we need to remember that when it's page one or chapter one of a story, we really shouldn't panic. That we can wait for some of this stuff come together, because complexity is many actors. Well, the adaptive part of a complex adaptive system is all of those actors are interacting, which makes it very difficult for us to predict the future and then make decisions like timing the stock market based on this. I'm going to share more about market data later, but what we've seen over the last 2 weeks is the stock market is basically flat in spite of what has happened. And it's been a good lesson that when things are scary, it doesn't mean that we need to all run for the doors, even though that's what happened for these Silicon Valley Bank depositors. So what are we going to learn in the coming weeks? Well, we're going to learn about some of the other ripple effects of these decisions. I'm sure there will be more actions and reactions to that. But ultimately, I want you to relax, because what we've seen is that there was swift and decisive action in order to stabilize the system. And as we look at this, this is nothing like 2008 and 2009, where there were these systematically important banks that were on the verge of going under and trillions of dollars needed to be pumped into the system. This is a much narrower set of issues impacting smaller banks, and the larger banks have actually been regulated out of taking a lot of the risks that led to this failure at Silicon Valley Bank. So in short, chill. Now, with that said, I do think there are lessons we can learn from what happened at Silicon Valley Bank. So, if you want to nerd out with me, this is the time to nerd out. If you don't want to nerd out with me, skip to the end with some of the key takeaways, and you can learn those takeaways and take those next steps. So for those of you who are money nerds like me, let's talk a little bit about what happened at Silicon Valley Bank. Well, it was the 16th largest U.S. bank with around $200 billion of assets. And over on the right-hand side, you can see a balance sheet summary. And just like you or I have a balance sheet that has assets and liabilities, assets are over here, liabilities are over here for them, a bank has this. And they served this crucial bank in the venture capital ecosystem. They held deposits for VC funds and also for venture-backed startups. And what happened is during 2021, tons of money flooded into the bank. 2021 was a time period where, coming out of 2020 and all of the concern of the pandemic, there was tons of money that was flooded in to try to help the economy, which had been temporarily shut down as sort of an allowance in order to give us some time to figure out stuff related to this deadly virus that was going around. What happened in the midst of that is the Federal Reserve dropped interest rates near zero. And then there were all of these stimulus packages. You probably remember getting your stimmy checks. Well, that was happening to businesses as well. A lot of that money found its way into risky investments. So it found its way into the hands of these venture capitalists who were then funding startups. It found its way into the stock market, which created not quite a stock market bubble, but definitely some inflated prices. It found its way into cryptocurrency, which definitely created a bubble. And it found its way into GameStop. And if you followed that saga, you know what happened. So all this money floods into the bank. Silicon Valley Bank started in 2020 with $102 billion of customer deposits. They ended 2021 with $187 billion in deposits. So an $85 billion increase in deposits. Now, what happens at a bank when they have these deposits, this is their balance sheet as of the end of 2022, is they take those deposits and some of it they keep in cash and some of it they have in securities like bonds that are available for sale, and so they can sell those quickly in case depositors need their money. But they also have some longer term assets. So these hold to maturity securities were $91 billion of bonds that Silicon Valley Bank had. And what they do is they'll pay the customers interest on their money, but they actually go and they invest that money in order to try to earn more interest. And that's one of the primary ways that banks make money. They'll also loan it out, and they'll loan it out at a higher interest rate than what they're paying their depositors. Very simple. So if you think about your net worth, which is what you own, your assets minus your liabilities, well, Silicon Valley Bank, when they reported at the end of 2022, it looked like their net worth was about $13 billion. They owned $208 billion worth of stuff, and they owed $195 billion worth of stuff. But this balance sheet wasn't in as good of a shape as people thought, because these securities had actually decreased in value. And so while it looked like they had $208 billion, there was actually less value in that portfolio than people thought. Let me kind of walk you through how this happened. So what Silicon Valley Bank did in 2021, when they got a flood of $85 billion of deposits, this is a huge amount, right? They started with 102, they ended up with 187. So they had a lot of money that came in a short window of time to invest. And remember, interest rates were very low when this happened. So they went and they thought, where can we go and get some interest on this money? They bought what they thought were very safe investments, U.S. government securities. These were mortgage-backed bonds in 2021. Well, that happened in 2021. And then later in the year, we saw this inflation issue where everything was increasing in price. There was tons of demand with more dollars in the system. People were kind of coming out of COVID and spending more on services, and a lot of goods. You remember things like cars, you just couldn't get them. They'd take 6 months. There were all these disruptions that led to things increasing in prices. When inflation started happening, the Federal Reserve looked at this and they thought, we need to slow down the economy because we don't want prices to keep rising. So they raised interest rates, which makes it more expensive for individuals like you and I to borrow money. It's more expensive right now to buy a house because, in part, the Federal Reserve raised interest rates, and so mortgage interest rates went up. It's more expensive to buy a car because of auto lending. It's more expensive to put money on your credit card. All of this is by design from the Federal Reserve, saying we want to bring down inflation, so we're going to reduce spending. So another impact of this is when the Federal Reserve raised interest rates, the value of those bonds that Silicon Valley Bank had bought in 2021 with all those customer deposits, they fell. Now, if the bank could have held on to those investments, they would have gotten back the full value. It wasn't going to be an issue. But the problem was, at the same time that those investments fell in value, what was happening to their depositors, these venture capitalists in these early stage companies? Well, venture capitalists were having trouble raising new money to put into funds because everybody's stocks and everything had fallen in value over the last year. And what were early stage startups doing? Well, they notoriously burn through cash. And so they had deposits at the bank and they started pulling out their deposits. So Silicon Valley Bank is looking at this and they're seeing this is not a good situation because we have investments that have fallen in value. We've got depositors who want their money back, and we might need to dip into those investments in order to pay back our depositors. So here's a very important lesson for you that I'm going to make as simple as I can related to bond pricing. And I think that this will be helpful if you've kind of never thought about this part of your investments, because bonds and interest rates, the price reacts inversely to what's happening with interest rates. So if interest rates go up, bond prices go down. And if interest price rates go down, bond prices go up. Why does this happen? I'm going to give you a simple, actually an oversimplified example of this. So with any bond, you've got a price that you pay, and then it's got a yield that it's going to give you, usually expressed as a percentage. It's got a term, which is how many years you're going to get that yield. And that's going to give you a total income over the life of the bond. At the end of that term, you get your initial investment back. And how you calculate the gain is the combination of the payback that you got plus the income over the term that you had the bond. So in 2021, to use round numbers, let's say that Silicon Valley Bank bought a bunch of 10-year bonds that were yielding 2%. So they would get $2 per year in interest. Well, over 10 years, they'd get $20 in interest. They bought them at full price. They'd get their full price back, so their gain would be $20. Makes sense. They were probably paying depositors 0% interest, so they were going to make $2 a year on every $100 that they invested. Well, what happens in 2022 is the Federal Reserve raises interest rates. That raises the interest rate on all bonds. So now they can buy a bond for $100 from the government, just as safe and secure, but it's yielding $4. Over that 10-year term, now you're going to get a $40 of income. You'll get your payback of $100, so your gain is $40. Here's where the problem came in. Silicon Valley Bank was looking at these 2021 bonds and saying, we might need to sell some of these to give money to our depositors. In fact, they did that. And that's one of the things that happened 2 weeks ago. They announced on Wednesday that they had to sell some bonds and they had to sell them at a loss. And that's what caused people to immediately look at the balance sheet and freak out. Why did that happen? Well, if you have a bond that pays $2 of interest per year, and I have a bond that pays $4 of interest per year, I'm not going to be at all interested in buying your 2021 bond at $2. What might make me interested is if we changed the price. So how do I get to my $40 gain on this 2021 bond now that 2022 bonds are happening? Well, if the price drops to $80, now I'm getting still $2 of yield. I can buy it for $80. I hold it for the term. I get my $20 of income, but I also get paid back the full initial value of the bond, which was $100. So $20 of income, $20 from this payback means that I get a $40 gain. So this is happening every day in real time with bond prices. As interest rates go up, old bonds that were issued at lower interest rates, they go down in value. As interest rates come down, these new bonds, they will actually increase even further in value. So this is important to understand because Silicon Valley Bank was looking at this issue that was coming up in their balance sheet because these hold to maturity securities, if they could have held them for 10 years, they would have gotten all their money back. But they weren't able to hold them for the full 10-year period because their depositors needed money. And in fact, this is part of the story. Notice that in 2021, they finished the year with $187 billion in deposits. By the end of 2022, they were down to $173 billion in deposits, which means already their depositors had burnt through $14 billion. So when they're looking at their balance sheet and they only have $14 billion in cash and they're on track to burn through maybe more than that this year, they needed to raise some cash. So that's what they said they were going to do. The people who looked under the covers at the portfolio that Silicon Valley Bank had, they really freaked out. Here's the timeline of events, and it moved very quickly. On March 8th, which is 2 Wednesdays ago, SVB Financial announced that they were selling securities, those bonds, at a loss of $1.8 billion, and they were going to sell some more stock to raise additional capital. They wanted to do this to keep things secure. There's a lot more that happened behind the scenes, but that's what happened on March 8th. Well, that day, when this news hit and people started looking closely at what was going on in their balance sheet, the stock market realized this is a huge issue because this bank doesn't have a $13 billion net worth. It might be actually closer to zero. So the stock fell by 60%. Silicon Valley Bank was scrambling to reassure their clients. They had a call with the CEO. The CEO basically said, hey guys, we've supported you for years, support us for years. People weren't buying it at all. That day of March 9th, people took out $43 billion from the bank in one day, so about a quarter of their deposits. Well, Silicon Valley Bank had to raise the funds to get to those deposits. They didn't have enough in cash. By the end of the day, they were just short. They were able to support or meet $42 billion of the deposits. Because they weren't able to get to that number, they were out of compliance. And so a California financial regulator on March 10th, which was 2 Fridays ago, said that they were taking position of Silicon Valley Bank. 2 days later on Sunday, I shared about this earlier, because the weekend was almost over and Monday was going to come and people were really concerned, the U.S. took emergency measures to protect all of the deposits at Silicon Valley Bank. This was super important to those businesses that had millions of dollars there and were wondering, if it takes us 90 days to get access to our money, does this mean we're going out of business because we can't make payroll in 2 weeks? So remember, the purpose of that was to both reassure existing depositors, but also to reassure the entire banking system that this wasn't going to lead to everybody pulling their money out of smaller banks. And 5 days later, Silicon Valley Bank filed for bankruptcy in New York. So this is a history of what happened. Now, did this happen all at once? Yes, sort of. But it didn't, because there were other banks who were buying investments in 2021 that didn't go out of business. Silicon Valley Bank took some additional risks that were designed to give them additional returns, which would have been good for shareholders. But as a result of taking those additional risks, they ended up going out of business and causing all of this turmoil. So before we get into some of the lessons from this seems like a really scary set of events. And if you look at the timeline, it happened so quickly. But this is what got everyone's attention. This is what had people asking me, should I sell out of the stock market? The stock market was down on the 10th as people were concerned about this. But let's talk a little bit about media myopia. And myopia just means nearsightedness, right? When you think about your stock investments, here's a pop quiz. I want you to look at these different things. And I want you to ask yourself an answer just as quick as you can. Are U.S. stocks up or down over the last week, the last month, in 2023 year to date, in the last year, in the last 5 years, or in the last 20 years? And I'm going to show you. Okay, first of all, stocks were up over the last week. That might surprise you given what the news has done. What about over the last month? Stocks are down over the last month. But actually in 2023 to date, the market is up if we look at all U.S. companies. Now, what about over the last year? Just check your portfolio. Stocks are down since middle of March of 2022. But over the last 5 years, stocks are way up. And over the last 20 years, the answer is way up. Now, if I were to give you all of these dates for any time in the market, if I were to give them to you for 5 years ago and say, hey, what happened over the last week, month, year to date, last year, 5 years, 20 years? What's interesting is we can actually plot market performance. And while the media wants to focus on the Silicon Valley banks of the world, what I actually want clients to focus on with their long-term assets, like a 401k, is what are the odds that over a 5 or a 20-year period, stocks will be up or down? And what this chart on the screen shows is something really helpful that can be instructive to us as we think about the time frame over which we should judge success or failure in our investments. So this is showing the S&P 500, the 500 largest US companies over the 90 years from 1926 to 2015. If you were to look each day, it's about 50-50. It's a coin flip. 54% of days were positive, 46% of days were negative. But if you looked at your portfolio over a quarter, the odds are a little bit more in your favor. In fact, about 2/3 of days, 68%, stocks are up, and 32% of days, stocks are down. You extend that out to a year, and stocks are up 74% of the time, 3/4 of the time, and they're down 26% of the time over any 1 year period. Over 5 years, it's about 5 out of 6 times, 86% of those 5-year periods are positive, 14% are negative. About a 1 in 20 chance over a 10-year period that your portfolio will be down, or that stocks were down during that period. So 6% negative, 94% positive. And then this 20-year stat is so reassuring. When you include dividend reinvestments, 100% of 20-year periods, if you were to look at any month to month over 20 years, stocks have been up. This is why it's so important that we not be nearsighted with our portfolios, that we not make nearsighted decisions. We want to not only be able to think about it that way, but in fact, when we look at near-term volatility, one of the things we can do is actually appreciate that volatility when we understand that we're in it for the long term. This is a quote from Warren Buffett that I hope you think about and really meditate on over the next few weeks, but hopefully even longer. That erratic markets are ideal for any investor, small or large, so long as he sticks to his investment knitting. Volatility, caused by money managers who speculate irrationally with huge sums, will offer the true investor more chances to make intelligent investment moves. They, the investor, can be hurt by such volatility only if they are forced by either financial or psychological pressures to sell at untoward times. I see my job as a financial advisor as to help you to make those intelligent money moves, smart money moves. And one way I can help you to do that is by, in times of volatility, making sure that financially you're not pressured, that you don't have a bunch of debt that we have to deal with, that you've got enough of a safety net for short-term spending, that we're not worried about tapping into your market investments, but also psychological pressures we want to manage. And this video is one way to manage those psychological pressures, right? To help you understand volatility is not the enemy. It is one of the costs of getting a higher return on your investment. So how do we take the pressure off? Here are a few ideas for us based on what we've learned from Silicon Valley Bank. The first thing that I want to share is you want to be really careful about single stock exposure. If we look here at all the holdings from the total stock market index that they have at Vanguard, here's the bad news. This is one of the biggest holdings inside of a Betterment portfolio. And notice that it owned Silicon Valley Bank. Actually, it's kind of fine because Silicon Valley Bank was such a small company relative to the entire stock market that of the over 3,000 holdings in VTI, this composed only 0.04% of a portfolio. 0.04% means that of every $1,000 you invested, it was about 40 cents would be invested in this, right? Of every $1 million that you invested into this holding, you would have $400 worth of Silicon Valley Bank. So does it stink that you lost your $400? Absolutely. But on $1 million portfolio, this is a blip in the radar. So this is a big reason we're careful about single stock exposure. Silicon Valley Bank is no more. All of the stockholders are totally wiped out. And that is an awful thing. And I feel bad for them. And honestly, it kind of seems like it didn't totally need to happen because everybody just ran to the exits. And if they had just stayed relaxed, I think the bank could have survived. But they didn't wait to see. And I understand why a company would do that when they're wondering, how do we make payroll? So we as investors, we want to measure and monitor single stock exposure. We've even gone further than this because in your Betterment portfolio, you don't just have this one holding. You've got a U.S. stock holding. Then we've got other holdings that represent U.S. stocks, international stocks, and bonds. So even in $1 million portfolio, your exposure would be even less than $400 here. Now, I've got clients right now asking me, hey, should I buy some First Republic Bank stock? And my answer is a resounding no. Because first of all, you probably don't know anything about investing in banking stocks and the fundamentals that support them. But secondly, First Republic Bank could go out of business. And we don't need to get crazy outsized trading-like returns to make your financial plan work. What we need to do is make sure we don't destroy money by speculating. And so that's why I'm always going to say, hey, let's avoid trying to trade this stock that's down 90% because we think that it's beaten down, because the market probably knows more than we do about that specific thing. That's part of that second point, which is monitoring our downside risk. I think one of the major failures at Silicon Valley Bank was that they did a poor job of understanding what would happen to their investments if interest rates rose. And this is not the first time that interest rates have risen. Back in 1994, there was a similar really big spike in interest rates rising in 1994 to 1995. It bankrupted Orange County. It caused a peso devaluation, and it was very disruptive to a few companies that had similar types of investments to what Silicon Valley Bank had. So we want to monitor our downside risk and build a portfolio and an entire financial plan that has a balance sheet that can withstand the pressures that could come in different market environments. It's a big thing I do in my financial plan. It's why we have insurance in place. It's why we have an emergency fund as part of your money tree. We want to monitor that downside risk and not just think about the returns we can get, but also the risk we're taking in order to get those returns. The third thing is we want to time our investments to our cash needs. One of the greatest failures at Silicon Valley Bank was they had depositors, these companies that needed money in the next 6 months, in the next year, in the next 5 years. And they went out and they took their money and they invested it in investments that they were hoping to hold on to for 10 years. This was a mistiming of their investments to their cash needs. And when they had to sell those investments just over a year later, it actually bankrupted them. So if you are buying a house in the next year, this is why we are saving in cash or in a bond portfolio. It's not a good investment to put money into stocks, even if they could go up in the next year, if you need that money in the next year. Because we just saw earlier, there's about a 25% chance that your stocks will go down in the next year. And those just aren't odds that I love for that time horizon. Now, money you need in 10 years, 15 years, 20 years, man, that is great to put into the stock market and actually is lower risk than keeping your money in cash because your cash will lose value over a 20-year time period to inflation, but your stocks should keep up in comparison. Okay, fourth and finally, to take the pressure off of you, right? Financially and psychologically, I want to just provide a reminder. Let's not overreact to chapter 1 of a breaking story. You guys did a great job of this. I can tell you, as my clients, that I did not see people overreacting. Nobody said, let's get all our money out of the market. You just asked me good questions. You heard answers, and we moved on. And so as we're going to have new stories that break over the coming months, I think it's so important to look back, and we can see over the last 2 weeks what happened. And the answer is not very much. I'm sure there are people in Washington, in Silicon Valley, who worked really hard to pull this stuff off. But for you and I, who don't have any impact on those decisions, we can actually just sort of stay the course, take a look at what's going on. And as a final little vignette or opportunity, here's what happens when we don't freak out. When we don't freak out financially or psychologically in the midst of volatility, it gives us opportunities. So Warren Buffett is famous for this. He says you should be greedy when others are fearful and fearful when others are greedy. And rumor has it that over the last 10 days, a lot of private jets have been flying out to Omaha, Nebraska to meet with Warren Buffett, who has about $130 billion in cash. And he is personally meeting with regional bankers who are concerned. And he is offering them investments and terms in order to take risk away for them, which will lead to a great return for Warren Buffett. So he's not freaking out. He's prepared for a crisis. And as a result, he will probably be somebody who benefits in the midst of it. And I think as investors, we want to be on that side of things. We want to be people who can be deliberate and decisive in the midst of crises because we know that we've monitored downside risk, that we're diversified, we've timed our investments to cash needs, and that allows us to take opportunities when they come up because of volatility. So you guys, thank you so much for watching. I hope that you found this helpful. If you did, I'd encourage you share it with a friend. Maybe this will illuminate some of what happened with Silicon Valley Bank for them. It'll teach them about investing a little bit. For my clients, remember, you can access your financial plan anytime at Right Capital through the app or by scanning on the screen. Same with Betterment. You can open up your app or you can access it on desktop. If you want to speak with me about this or anything else as a client, head over to redwoodmoney.com/meet or shoot me a text at 408-617-8757. I really appreciate those text messages, especially in these times, because I probably wouldn't be shooting this video if it weren't for the number of texts that I got, the range of questions. It told me, hey, the best thing you can do in this week is take some time, shoot this video, provide some information. So thank you for watching. I look forward to our next meeting, and we'll talk soon.